It is Wednesday, October the 25th, 2017. I'm Gord Long. As is normally the case, we have a lot of charts for us to go through this morning, so therefore we will pass over some of them quickly, but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing, or you'll not be able to see some of the detail I'll be discussing in the individual charts. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. The purpose of the audio is to discuss key developments in those areas not specifically updated in this month's macro online updates. The research document this month updates global macro developments. Therefore, the slides this morning will focus on our other three report areas of our monthly report: the global risk, regional, and U.S. economic developments. As I often do, I'd like to tie them together into a discussion on the conundrum the Federal Reserve faces at its upcoming November the 1st FOMC meeting, as well as what likely lies ahead for them and us. I would therefore like to cover the items outlined here. What is the conundrum? The Federal Reserve has been very clear through its forward policy guidance that it will slowly increase the Fed funds rate. Slow, however, should be more appropriately described here as at a glacial pace. Additionally, and maybe much more important, the Fed plans to gradually reduce the central bank's balance sheet at a slowly increasing rate, a rate that over 15 months totals only 10% of the approximate $4.5 trillion growth in the Fed's balance sheet since the beginning of the Fed's quantitative easing and ZIRP policy initiatives. The general perception is that going forward, the Fed will either 1. Raise rates and reduce balance sheet, as is being presently signaled; 2. Do little, in reality what they're actually doing, or marginally do nothing further; or 3. Resume another version of quantitative easing to the infinity, any number of new versions of it, plus negative policy rates referred to as NIRP, and possibly helicopter money, amongst other things. Why quantitative tightening? The expressed reason for the requirements for normalization of U.S. monetary policy is that the U.S. economy is now over 8 years into the recovery with low unemployment rates and signs of a broad-based, though weak, recovery. It is my opinion both of these conditions are not valid. However, I'll leave that for another day. Instead, I'd like to suggest what may be a few publicly undisclosed considerations on the table in the closed-door discussions, or at least at sidebars. Having lived through and as an investor participated in 1987, 2000, and 2007 crashes, I learned a number of lessons. One is the importance of advanced shifts in the currency, credit, and yield markets prior to major reversals in the equity markets. The yield curve is of particular note since it is presently almost completely ignoring the Fed and has been steadily flattened. This is not common. This is highly unusual unless it's preceding something of significance. This is problematic, especially for the Fed. We can see that the 210 U.S. Treasury spread is below the dotted red line, which has always preceded a major market correction, as well as a U.S. recession. What I learned was that there is always a shock or surprise, shown in blue, which comes out of nowhere during this period. What that surprise is doesn't really matter, except it occurs because of hidden underlying market dislocations, extreme valuations, low volatility, market speculation, excess leverage, etc., all contribute. But they are not in themselves the direct cause. They simply all contribute together. The only thing you can be certain of is that market fragility will abruptly fracture. The Fed is acutely aware of this and knows it must be fully prepared when that occurs. The irony is that quantitative tightening will likely contribute to this fragility and shock. Therein lies the FOMC's conundrum. We can see the yield curve comparison prior to the 2000, 2007 tops along with today's levels here. Though the yield curve is not flat or inverted yet, it is set up for exactly that to occur. The black line shows that a couple of minor Fed rate hikes on the short end and a shock which precipitates the normal flight to safety we always see in such cases into the security of longer-date U.S. Treasuries, and then the yield curve would be flat to inverted in a New York minute. In a recent article entitled Euphoria and Greed, the final 5% is always the most expensive, I pointed out how the Consumer Comfort Sentiment Indicator is historically an important institutional tool in assisting with this timing. Since posting that article, U.S. consumer comfort has plunged the most in 13 months as personal finance fears mounted. You can expect that to continue. What may be a conundrum for the FOMC next week need not be a conundrum for us. To fully appreciate the conundrum the Fed presently faces, we need to also understand the importance of three major activities operating independently yet intertwined in three different areas of investment influence. Central banks have been heavily committed to quantitative and ZIRP after the 2000 financial crisis. This has produced credit and liquidity, which I will label flows. Corporations, separately, have been heavily committed to stock buybacks since the advent of quantitative easing and ZIRP. These activities have fostered major movements in equity valuations. Public investors have shifted in parallel from the use of active managers, i.e. mutual funds, to investment vehicles such as quick entry and quick exit ETFs, which have become dominated by those tracking the major indexes or popular assets such as the FANGs. This shift has fostered passive investing. Unfortunately, the unintended consequences of these three entities has the potential to now create a perfect storm. Central banks are reversing policy to quantitative tightening. Meanwhile, corporations are reducing the rate of stock buybacks, and public investors are heavily into passive investments that may lack liquidity at this stage and size if aggressive selling occurs, which is specifically the reason they were bought in the first place. Consider the degree which these shifts are occurring. Central banks, going from quantitative easing and QQE in Japan and ZIRP, are now going to quantitative tightening and normalization. See the impact here, and it's dramatic. Let's talk about corporations. Share buybacks are now falling, and their effect is being quickly reduced. As the chart shows, they're falling at a rate of 20% per annum. That is, again, significant, but separate. Investors, that is in passive investments, ETF growth, is now seeing professionals leaving and the public rushing in. The institutions, shown in the orange, and the private investors shown in green here. However, if you really look at the equity flows, passive and active, you can see how dramatic it is. Who is selling as active are the institutions. Who are buying as the passive are the ETF, the public. The institutions themselves are not charging into ETFs, the best that I can tell. This is the degree of which the separation is now occurring. The psychological issue with the collapsing unholy trinity will be the perception of the withdrawal of the Bernanke-Yellen put. The central banks will no longer be seen to be supporting the higher asset values in its stated quest to stimulate consumer demand through the wealth effect. This may be the bigger issue than the simple reality of the individual components that I just outlined, and it will change. But when it changes, and it will change, it will be abrupt. Let's talk about the constituents to this conundrum. The Federal Reserve is being pulled in different directions by major stakeholders in the U.S. and global economy. On the one side, in this chart, we see the Central Bankers Bank, the Bank of International Settlements in Basel, Switzerland, is out with a major paper concerning the magnitude of the coming inflation problem, which they feel country central banks must be now aggressively preparing for. I'll be talking more about the BIS research in an upcoming macroanalytics video with Charles Hugh Smith. Meanwhile, the major central banks of the world are all talking about various levels and time frames for quantitative tightening. The question is just how much of this is nothing more than spin, or just trying to talk the markets into more fiscal discipline, less speculation, and being more prudent. If that's the case, they're not being successful. On the other side of this chart, we have both the U.S. economy and Wall Street basically promoting continued low rates and stimulus, for different reasons, obviously. In the middle, we have the government actually needing both for conflicting reasons, as shown here on the bottom. An equilibrium balance must somehow be struck. The chances are high that the solution will be minimally superficial change until the choice is actually made for them. That's the modus operandi I have continuously witnessed over 30 years. At that point, the central banks will be forced by all the constituents to react. However, as you would suspect, there is a problem in continuing to kick the can down the road, which has been occurring for 8 years. The Fed is quickly running out of roadway. Our 2010 thesis paper was entitled Extend and Pretend, and we have witnessed this as we have papered over the underlying issues causing the financial crisis ever since. We did a video here recently on financialization, just outlining the timeline and the changes that the central banks and the regulators have done to keep this train moving forward. They continuously change the goalpost and change the rules. Though we perceive things to be currently stable, in actual fact, this is not the case. It's hard to see. Unusually high market levels, as measured by a large basket of historic metrics, which we are currently experiencing, is inherently unstable. We may have equilibrium, but is likely going to be short-term on a relative base. It's temporary when you get this degree of elevated long-term historical metrics. A better way to view this equilibrium or temporary stability is shown here. Something always occurs which tips the balance. Then we quickly discover whether something is actually stable or in fact unstable. Like an avalanche, everything appears stable and in equilibrium until it abruptly isn't. It is a delicate balance the Federal Reserve is attempting to manage. They may be successful in the very near term, but the chances of sustaining this are absolutely against them. Let's consider just one of the many factors working like a glacier against them. Occurring massively without little apparent notice is the shift in population distribution. We have approximately 84 million baby boomers now retiring at a rate of over 10,000 per day. These are people who have assets, have pensions and the like, are past their high consumption years, will be drawing down pensions and assets to support their later years, and will consume less and spend that on different things like travel, health care, and dental or medical, etc. On the other hand, we have nearly 75 million millennials taking their place in the job market and are now in their high consumption years, theoretically. These are people who have little money and even less unencumbered assets, who are broke with high student loan debt levels, are finding high-paying jobs scarce, who are getting married, starting families, and buying houses much later, matter of fact, well over 10 to 12 years later, who are forced to consume less with basic subsistence needs simply being the priority. How does this bode for the Fed, who are reliant on a 70% consumption economy for GDP growth and to create balance? This chart shows how things have been held together before this shift fully accelerated. The shell game has been cheap and readily available consumer credit, for example, from Fannie Mae and Freddie Mac government conservatorships funding 95% of all U.S. residential mortgages, and government transfer payments like 54 million people who are on food stamps and many other government assistance programs. I just noticed the other day that disabilities are absolutely through the roof now. I wonder why that is, why we're suddenly having a population in disability. The Fed's choices available to them to not destabilize border, to me, on the nearly impossible. But it gets worse. The reason is because our current economic growth is fundamentally an accounting illusion. I laid this out in this year's thesis paper entitled The Illusion of Growth. This chart from a recent post on Meta SII illustrates what happens if we reasonably consider that debt is simply not income. Stands to reason. Is your debt income? Let me explain. Consider that someone not employed and making no income, yet receiving some sort of government subsidy or transfer payments to live on, which is financed through government debt. That debt is considered income in our 70% consumption economy. Does that make sense to you? It may have been well and good when overall debt levels were low, Government entitlements were low, government debt was low, and consumption was down at 35% of the economy. But not today. One of the things I learned early in studying engineering as a young man was that formulas often had boundary conditions. Outside of these boundary conditions, the formula no longer provided accurate or reliable results, or even for many cases would work at all, often because the underlying assumptions were simply no longer valid. They changed. This chart shows that by simply not allowing debt to be considered as income, that is, the formula now is outside of boundary conditions, the U.S. in fact is in a depression. Economic growth has been plummeting for the last 10 years. So what we have minimally is something close to a dam breaking. First of all, we have the illusion of debt considered as income. We have 2, high levels of government dependencies, transfer payments and consumer credit. And 3, we have underfunded global entitlements, which now are approximating $400 trillion in pensions, which must be funded out of the financial markets. I've kept the list very short here. It is much longer than this. But it is sufficient to see that somehow the Fed must keep things together. Somehow, in spite of all of this, the Federal Reserve, therefore, is likely to continue to do little to nothing until such day as the dam actually breaks. Then we will see some forms of quantitative easing and NERP and helicopter money and guaranteed facilities and more entities placed in government-sponsored conservatorships. We're seeing this, and this is a chart that we've been tracking here for 2 years now. And every time we get into a little bit of a problem, they change the rules. There are a lot more rules not outlined here, but it just shows you where we're trending towards, and that is more government control of the financial market in various forms. Let me give you a final thought for you to think about before we end. If you're confused with the terror, social unrest, and near police state you are seeing on your nightly TV news, as well as the issues we've just outlined, then remember what Vladimir Lenin observed well over 100 years ago. Fascism is capitalism in decay. Don't react to fascism. Understand that as the marriage between governments and corporations and centralized control. Just maybe we shouldn't be allowing central planning and control institutions like the Federal Reserve to be making these monumental decisions for us. Aren't they partially responsible for getting us into this position in the first place? So in closing, as I continue to do in ending these shows, is remember, they'll print more money. It's the only answer politicians will ever agree on. Invest accordingly. They will do this until no one wants the money or trusts it. That day's still in the future. I'd like to take a moment as a reminder. Do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisors. So until we talk again, may the remainder of 2017 turn out to be an outstanding investment year for you and your family. Thank you very much for listening.